Welcome to The Explainer. Today, we're digging into a real head-scratcher from the premium tea brand茶姬. Their latest results were, well, confusing. They showed massive growth, but their stock price went in the complete opposite direction. So let's figure out what's really going on.
So let's get right into it. This is one of those situations that honestly leaves you scratching your head.茶姬puts out its Q2 2025 earnings, and on paper, things look good, but the market, it had a totally different reaction. It's a classic case where the headline numbers and the market's gut feeling just don't line up. I mean, just look at this. It's totally contradictory, right? On one side, you have the company's network of tea houses growing by an incredible 40.9%. That's huge, but on the other side, the stock gets hammered, dropping over 13% right after the announcement. So what on earth did investors see that the big growth number was hiding?
All right, so to figure this out, we got to start with the profit puzzle. This is clue number one, and it's a big one. A massive drop in the reported profit that really seemed to spook everyone.
And here's the number that sent shockwaves. We're talking about GAAP net income. That's the official, by-the-book, standard accounting profit, and it fell by a staggering 87.7% from the same time last year. Now, a number like that, it looks like an absolute catastrophe, but is it really? Okay, so to get to the bottom of this, we have to talk about something that sounds kind of boring, but is super important here: the difference between GAAP and non-GAAP. Just think of it this way. GAAP is the official number with all the strict accounting rules. Non-GAAP is like the company saying, hey, hold on. If you just ignore a few unusual one-time things, this is how our actual business is doing. And here it is. This is where we find the smoking gun, hiding right in the numbers. You see that scary-looking 77 million RMB profit? Well, look what happens when you add back this enormous expense for share-based compensation. We're talking over 500 million RMB. And the key thing here is this isn't cash that actually went out the door. It's an accounting charge tied to their recent IPO. And boom, just like that, the real picture comes into focus. You take out that one big accounting item and suddenly that catastrophic profit drop, well, it disappears. Their underlying profit, that non-GAAP number, was basically flat. So, okay, the profit collapse wasn't a real collapse, but that means investors were worried about something else, something deeper.
So, if the profit thing was just an accounting quirk, what was the real problem? Well, that brings us to part two of the story. And this is a classic tale of two markets. You've got what's happening in China versus what's happening in the rest of the world.
You see, the real reason for all that concern, all that red on the stock chart, was a pretty sudden and sharp slowdown right in their own backyard, their home market of Greater China. This is their bread and butter, their heartland, and things were starting to look a little shaky.
And this chart, wow, it really lays it all out, doesn't it? It's like night and day. On one hand, sales in their existing stores in China, that's what we call same-store sales, dropped by a really concerning 23.1%. Now, their explanation is that they're trying to stay out of a crazy price war over there to protect their premium brand. But at the exact same time, look at their overseas business. It absolutely exploded, up more than 77%.
So what do you do when things are getting tough on your home turf? You go on offense somewhere else. And for茶姬, that means making a huge bet on America.
And they are not just dipping their toes in the water. They are going all in. Look who they hired to lead the charge. You've got Emily Chang, who was the marketing chief for Starbucks in China. She knows how to build a premium brand. And then there's Aaron Harris, one of the key guys behind the insane growth of Dutch Bros Coffee. I mean, these are heavy hitters. These are not your average hires. And you know, analysts were quick to point this out. One of them put it perfectly. This isn't just shuffling some names around. This is a signal. It tells the world they have a serious, well-funded professional plan to take on the US market, which, let's be honest, is a really tough nut to crack. They're bringing in the A-team. Okay, so we've got this really interesting dynamic, right? A struggle at home, but this massive opportunity abroad. So if you're watching this company, what are the key things you need to look for going forward?
Well, people who follow this stuff closely are focused on three main things. Number one, can they stop the bleeding in China? Can they get those same-store sales to flatten out and hopefully start growing again? Number two, can they keep that amazing international growth story going? And number three, and this is a big one, can they do all of that without wrecking their profit margins?
And really, it all comes down to this one big question. Is this huge global ambition going to be enough to make up for the problems they're having back home? It's such a classic business dilemma. Do you focus on defending your core territory, or do you go out and try to conquer new worlds? Right now, the market is punishing them for the weakness at home. But the real test is whether their big bet on the rest of the world will prove that punishment was short-sighted. I guess we'll just have to watch and see.